Hi everyone, I'm Sam, and in today's video we are talking about index investing. In the first part of this video, I'm going to cover all the important things you need to know about index investing, including what it is and how it works. After that, I'm going to dive into our personal index investing strategy, where I'll tell you what fund we are buying, why as self-proclaimed value investors we're doing index investing in the first place, and by the end of this video, I will show you every single trade we have made for the past 7 months and how our portfolio has performed to date. Now, I've added chapters to this video, so feel free to skip around to the content that is most relevant for you. If you are just getting started with stock investing, interested to learn more about index ETFs, are struggling to find an investment approach, or you just want to take a peek at our portfolio, stick around because this video is for you. Index Investing 101. Let's start off with some key terms and basic information to make sure that we're all on the same page. Index investing is a passive investment technique that uses a buy and hold strategy. And the goal of index investing is to generate returns that are similar to a broad market index. In other words, if the overall market does well, your investment will usually do well too. And a broad market index is a basket of securities that are grouped together for the purposes of analyzing the market. And indexes and the way they move provide a great deal of insight into the economy, into the investing public's risk appetite, and into trends of investing diversification. So when you hear people say things like, "How's the S&P doing today?" or "The Dow Jones is up 50 points," they are talking about indexes. An exchange-traded fund, or an ETF, is a basket of securities that trade on an exchange just like a stock. An index ETF is designed specifically to replicate a benchmark index such as the Dow Jones, NASDAQ, or S&P 500. So what are the benefits of index investing? Since index investing takes a passive approach, index funds usually have lower management fees, referred to as expense ratios, than actively managed funds. Index funds also tend to be more tax efficient than active funds because they make less frequent trades. And more importantly, index investing is a really effective way of diversifying against risk because an index fund consists of a broad basket of assets instead of just a few investments. Also, there are a bunch of studies that show that typically index investing outperforms actively managed investing funds over a long time frame. So in summary, a lot of people like index investing because they see it as a low risk, low cost, low effort strategy. So if you decide that you want to invest in an index ETF, there are 4 key things that I would recommend you consider to help you decide which one is right for you. Number 1 is the underlying index. Number 2 are expense ratios. Number 3 is liquidity. And number 4 is dividend yield. So when I say that you should consider the underlying index, what I mean is that you have to decide which index you think is going to do well over the long term. And remember, indexes are baskets of securities that are grouped together. The Dow Jones is the oldest out of the 3 major US indexes, and it only has 30 constituents. It is a price-weighted large cap index, and that means that the overall value is determined by the daily price of its constituents. The S&P 500 on the other hand, is a market cap weighted index of large cap stocks, and it has 500 constituents, and they represent a really diverse set of companies from multiple industries. And many investors say that if you invest in the S&P, it's kind of the best representative of the overall US economy. Now, the NASDAQ has more than 3,000 constituents, and more than half of those stocks are in the technology sector. And Investopedia says that if you want to capture gains of a broad swath of the market, then the S&P 500 is your best bet. However, if you are interested in a safe strategy that mirrors price movements of well-established blue chip stocks, then the Dow is a really good choice. And finally, if you would like greater exposure to the tech sector, then an investment in the NASDAQ will focus your portfolio. Okay, moving on to expense ratios. So expense ratios could also be thought of as brokerage fees, and essentially they are how much the brokerage or the money manager is going to charge you. And obviously the lower this number, the better. And liquidity refers to the quantity of shares of the ETF that are traded on any given day, and it determines how easily you are able to buy and sell your position. Low liquidity ETFs can be difficult to buy or sell without impacting the price. And finally, most index investments produce an annual dividend yield, and you should look to see what current percentages are in order to give you an idea of what you could reasonably expect in the future. And in this case, the higher the percentage, the better. Okay, so now let's talk a little bit about what you do when you are actually ready to buy. The process of buying an index ETF is super simple and straightforward. All you have to do is have a brokerage account, and personally, Chris and I use TD Ameritrade. After logging in, we just type in the ticker symbol for the ETF we want to buy, click buy, enter the quantity, review the order, and then place the order. It's as simple as that. And this leads me really nicely into part 2 of this video, which is our personal strategy. Let's start with this question. Why index investing in the first place? So honestly, Chris and I were not interested in index investing for a really long time. We had the attitude that because we are value investors, we want to deeply understand each company that we invest in. We want a more concentrated portfolio, and we want higher returns than what index investing typically offers. But 7 months ago, we changed our mind about index investing, and here's why. First, we wanted to get more of our money working for us. We all know the market is bullish, or at least it is on the day that I'm filming this video, and it has been for a while now. Now, Chris and I have been very strict in following our own investment rules, essentially looking for wonderful businesses at fair to discounted prices. And we have been finding it more and more challenging in recent years to find what we consider to be wise investments. So we're sitting in a lot of cash, and the FOMO is real. Honestly, sometimes we feel a little bit like Chicken Little by sticking to our value investor guns, but it's worked for us thus far, and we still believe very strongly in what we're doing. Okay, so anyway, we started seriously considering how we might participate in index investing in a way that still fit into our value investing strategy. So ultimately, we decided that we really liked the idea of it being a systematic approach which removed emotions, and we felt that by implementing a cost averaging strategy and only allocating a really small percentage of our overall portfolio, we could get on board with index investing. Now, full transparency, the other important reason we decided to give index investing a try is because we are now in a new phase of our financial freedom journey. So we've been investing for more than 12 years, and the size of our nest egg has really grown significantly. We checked off a huge milestone recently because Chris retired from his 9 to 5 while he was still in his 30s, and we're now in a position where we actually feel okay to let that money stay in the investment for a very long time if need be, and we're not going to lose any sleep if the index goes down in the short term. We're also okay to expect a more modest return on our investment than what we would try to achieve with our other investments. So now that you know the why, let's talk a little bit about the what and the how. The index ETF that we currently invest in is the Vanguard S&P, or the VOO, and we wanted to go with an ETF that followed the S&P 500 because we really liked the wide diversification, and we liked that the S&P 500 historical returns are approximately 10%. So that means that the money we had invested would essentially double every 7 years over any long period of time. And also, Warren Buffett, who we think is the greatest investor in the world, recommends that most people invest in the S&P, and we like to listen to what Warren Buffett has to say. So 7 months ago, when we decided that we were ready to start index investing, we did a comparison of the 3 major index funds, and in this table, you can see exactly how the numbers stacked up. We decided that the VOO was the right choice for us because it had a low expense ratio, we liked the dividend yield, and the 1-year return. And also, the VOO is the 3rd largest S&P 500 ETF, so it has plenty of liquidity for us. Now let's talk a little bit more about cost averaging. So we invest $2,500 every month into the VOO on the first trading day of the month, and we've done so for the past 7 months in the row. And on the screen, you can see the table listing all of our purchases. In summary, to date, we currently own 42 shares of the VOO and have spent just under $17,168 out of pocket on the investment, with an average cost per share of about $408. The main reason we use a cost averaging approach is because it really removes emotions and it mitigates some of our risk. Because if the VOO goes down from 1 month to the next, we're actually cool with that because it means that we also get to take advantage of the lower price, because as we buy more shares, it just reduces our cost basis. And that is a much better position to be in than if we had just bought a bunch of shares all at once at the beginning of our investment and we just had to sit there and watch it all dive. That would be super stressful. And moreover, it's really hard to accurately value a single business, let alone 500. So this is our way to spread our investment out over varied valuations and prevent having a massive investment at the absolute worst time. In fact, as I'm filming this, the VOO is trading today at about $397 per share. So if we were to sell all of our shares today, we would have a loss of about $462. But this is a long-term investment, so we aren't selling today. In conclusion, Chris and I think that index investing is a great option for folks who want to take a more passive approach to their investing process. But please do not forget that I am not a financial advisor. I am definitely not your financial advisor, so please do not take this video as financial advice. If you want to follow along with us, be sure to subscribe. I do monthly shorts to keep you updated on the performance of our index portfolio. Thank you so much for watching. I hope that you found this video useful. I'd love to hear from you in the comments. Let me know, would you invest in an index fund? Why or why not? Remember, earn more, spend less, and invest the rest, and I'll see you next time.